Welcome everyone to part 5 of our CEO series. And today I'm very excited. We have the CEO and co-founder of Motivo. Welcome.
Thank you. So happy to be here.
Very excited about this conversation. Let's get started. You can go ahead and share your screen.
Awesome. I see everybody too and the attendees. It would be super helpful to me to know like where you're calling in from. I just always love that. If you want to throw that in the chat, it makes me feel like it's not just me talking to, a Zoom screen with Jacqueline. So thanks, Jacqueline, so much for having me for this. We were talking about like different topics that maybe would be interesting to people. And this was one that I thought of just like, gosh, I would have loved to have known in the early days of Motivo, what fundraising, what was involved in the process, how to even get started. What are some of the terms that I keep hearing thrown around even mean? And so I thought I would just put together like basically everything I've ever learned about fundraising for a mental health startup into one deck, and would like just welcome everybody's questions throughout the presentation. You feel free to put them in chat or Q&A or whatever, and we can answer them in real time. We'll also, leave time towards the end for some good questions. So just thanks so much, Jacqueline, for all you're doing with therapists in tech. It's like so remarkable, the community that you all have built, and I'm thrilled to be a part of the community and to also be talking to some of your folks today. So here are a few things that I want to go over during today's presentation. I want to talk a little bit about, what is Motivo? What does it do? Why did you raise money? Just pretty briefly, and then review the different types of funding that are available to startups. I'm going to go over some key terminology. I'm going to talk about like whether or not you should raise, like some questions to ask yourself when determining that, and then some of the lessons learned that I've had over the years. And then I'm also going to share an example pitch deck, my own pitch deck, and then some resources. And then also Q&A. So just super briefly, I got into this field by being a clinician myself. I'm a licensed marriage and family therapist, and I started Motivo to solve a problem that I experienced on my own road to licensure, which was lack of access to a clinical supervisor. I'm from a rural area of North Georgia. When I was working towards my license, the closest LMFT supervisor was 2 hours away in Atlanta. So I was driving back and forth to Atlanta each week to get all of my supervision hours. Had to be done in person at that time. I stuck with it. I got licensed. And then several years later, I noticed that states started passing rules saying you could do your supervision virtually. Many states began to get on with that same trend. And even COVID brought a lot of states even more to the threshold of allowing virtual clinical supervision. So I thought, well, it would have been so much easier if I could have seen my supervisor through video, and maybe I'll just create a company to try to see if that would, if other people had the same situation that I did. And so what I did was I used Shopify. I have no technical background or experience, and I just created a platform using Shopify. I uploaded a bunch of supervisor profiles, a lot of my friends, a lot of other supervisors I was able to find, just to see if anybody would be interested in this. And we started taking off that way. MVP is a big term in startup world. It stands for minimum viable product. And it basically just means what kind of product can you put out into the world to even determine if there's people who want to buy your product. So that was my attempt at that, even though I didn't know what MVP meant at the time. That was my attempt at that. So Motivo is really focused on just solving the provider shortage. I think this is a pretty staggering statistic that 64% of the people who get a master's degree in counseling never complete their licensure. They fall off somewhere along the way because supervision's expensive, or the pay is too low for an early career clinician, or we use our greenest clinicians to work with some of the most vulnerable populations. I'm sure I'm speaking to the choir here. These are all the problems that exist in the early years of our profession that keep people from making it through. So Motivo is just about making all that easier. Today, we have 20 employees. We're fully remote. We have about 1,200 clinical supervisors across the nation providing virtual clinical supervision. And we work with about 95 community mental health organizations or digital health companies delivering their clinical supervision through our network. We've helped over 1,000 people get licensed, which is really exciting. And we've raised $16 million in funding from venture capital and angel investors. And I'll share a little bit more about my process in doing that. We've also recently launched a continuing education platform called Motivo Learning that is fantastic. And you should check it out. So quick disclaimer, I always just like to mention that, this is like completely subjective. My own experience, it might or might not be relevant to you. If you've ever been part of like a 12-step community, I have in my life. And one of the things they say is take what's helpful and leave the rest. And that's what I'd like to leave you with today. Take what's helpful and leave the rest. Some of this might work for you. Some of it might not work. You're really the best expert on your company. If you're a company leader or thinking of starting a startup. And that's part of the reason that this is so hard, because there's not anybody to give you the answers. You kind of have to figure them out for yourself. So let me just check the chat right here. I want to see if I can pull this up too. Will you just alert me if I think I'd have to stop sharing my screen to see the chat. So will you just tell me if there's a question? Okay, cool. Thanks, Jacqueline. There we go. Okay, so the types of funding. I've put 4 main types of funding that's available to startups here. One is crowdfunding. If you've ever heard of crowdfunding, it's when you have a platform where you go on and you say, this is the service, or a lot of times it's very product oriented. This is the product that I'm trying to launch into the world, donate to it here. And if you donate, you get this prize once I raise this much amount of money. It's pretty, easy entry. Anyone can do it. It does work better for B2C. It doesn't really work that well for B2B. Those two terms, I'll just briefly explain. B2C is business to consumer. An individual is buying your service. B2B is a business is buying your service. And then it also works better with like tangible products, like something that you could like give away or get people really excited about. I don't know that would work for Motivo. Like, invest in Motivo, like it's just difficult to do it. Like people need to see kind of the tangible results of what they're investing in. And it really requires a network or following to get people excited about it. Another one is accelerators. I went through 2 accelerators with Motivo. I went through a local one in Chattanooga, Tennessee, which is where I live. And then I went through Techstars Atlanta in Atlanta. And accelerators are really interesting. Many of them are free. They don't give you any money, but they don't take any equity. But a lot of the big and the best ones, like Y Combinator, Techstars, 500 startups, they take some equity in your company, usually around 6%, in exchange for usually around $150,000. So it gives you some seed money to get started with, but it takes a pretty big chunk of equity. 6% is a lot, but when you're just an idea, it's a great way to get started. And I will send this deck to Jacqueline to share with everybody, or actually, I don't know if she has everybody's email. Jacqueline, do you want to send it out that way or should? Okay.
I have.
You do it. Okay, great. So we can send out the deck in case you want to check this out. Angel investors are high net worth individuals, so just rich people who are giving money to a startup, investing money in a startup, and they are hoping to get a return, usually 4 to 5x return, usually smaller check size, anywhere from $10,000 to $250,000. There's a few different angel networks where you can be a part of and share your idea. It's a good way to kind of get your foot in the door. And then venture capital is the main focus that I'll talk about today. That's usually where most startups get their most significant amount of funding. And these are investment firms, so really big companies that raise capital from other LPs, what's called limited partners. Sorry, my puppy is visiting us. So limited partners are like hospital endowments, universities, Fortune 500 companies. These are large companies that VCs go and raise money from. So VCs kind of do the same thing that founders do. They also go out and raise a bunch of money. It's usually $200 to $500 million that they are raising from these really, really, really big companies. And they're saying, like, give us, X amount of money, and we'll go and invest in the latest and greatest startups and help them grow. That's how venture capital money works. And because they have to return that money to those LPs, those limited partners that they have taken money from, they're looking for a pretty high return, usually like 10x return, more pressure to grow quickly. Oftentimes with venture capital, they're looking for big wins and investing in startups that have like a big market opportunity. So I'll just give a little bit about Motivo's funding timeline. So $30,000 home equity line of credit. I didn't know what I was doing when I got started in Motivo. I tried to see if I could take out a home equity line of credit to start my company. I quit my job and was, obviously, let me just acknowledge my own privilege that I was able to do that, because I had a husband as well who was supporting most of my income. But we did do a $30,000 home equity line of credit. And then I got $75,000 from two local angel investors, $125,000 from Techstars Atlanta when I went through the accelerator. And then that led to our seed round of $2.2 million in 2019. That gave us what we needed to grow to Series A. So let me just kind of double click on a couple of these things. Investors like to see that you've put anything into your company, because it shows that you've put some skin in the game and that you're really, invested, not just trying to get money from other people before you've put your own skin in it. It's not a have to have, but it's nice. Getting money from anybody, getting investments from angels, it signals that somebody thinks that you have a good idea. Getting accepted to an accelerator signals that somebody thinks that you might have potential product market fit. And I'll go into what product market fit means. And then 2.2, you need to at least have some revenue to raise a seed, a little bit of traction. I like to just point out that more credible startups die here between seed and Series A than any other time. So non-credible startups, meaning you had a good idea, but it wasn't a good enough idea to get the company going, would die before this. But if you have a little bit of traction, but the timing's not right, or something happens in the market that impacts your ability to scale, it's really hard to get to $1 million in ARR, annual recurring revenue. And that's really the starting line for most venture capital funds. So you have to get to that in order to raise a Series A, which we were able to do, which was great. And then product market fit is usually you're, kind of deemed like, okay, you have product market fit if you've been able to get there and raise a Series A. So let me just pause there and just see so far if there's any questions. I'm going to stop sharing my screen and just look at the chat. Anything anybody wants to ask me about specifically around the types of funding or Motivo's story so far?
I just want to say thank you for sharing that personal bit of information about taking the home line equity. Mm-hmm. I mean, people don't share that information. So thank you for saying that. Yeah,
I'm brutally transparent. It gets me in trouble sometimes. People are like, don't talk about that. But I do. How many VCs did you interview? I would say, pitch to is a better term for it. I don't interview them. I'm pitching to them. And I would say, I don't know, at least over 100, probably. Maybe 50 for the Series seed and another 50 for the Series A, something like that. And a lot of the people that I pitched to during the seed stage, I would later pitch to a Series A, because the very common response is, this is interesting, but you don't have enough traction to, or we only focus on Series A companies. Some investment firms only focus on Series A. So they might take a call with me when I'm at a seed stage, but they wouldn't invest until Series A. So that relationship kind of starts early and we continue to talk as we go. Is clinical supervision restricted by the state line. You have to have a license in the state where you're supervising. You don't have to live there, but many of our supervisors on Motivo have license in multiple states. They can supervise in multiple states as long as they meet those qualifications, but you have to have a license there. Where did you get business guidance from early on? Really, it was Techstars, both the accelerator programs. So I went through CoLab in Chattanooga. You could probably Google your city, especially if you live in somewhat of a, mid-sized to larger city. I mean, Chattanooga is like the 4th largest city in Tennessee, so it's not that big. But most places have some sort of incubator. Sometimes it's called incubator. Sometimes it's called startup or accelerator. And that was very helpful early on to me. I think there was like a Monday night class that I did for 6 weeks. And then I got into this like 2-day-a-week accelerator program. And then Techstars, which is like full-time for 3 months, definitely couldn't have a full-time job during that. So that's where I got all of it. I also have a lot of books that I'll recommend that were super helpful. Books and startups, and then they're later in the, books and podcasts later in the presentation. I still learn primarily through that way. And then how did you find VCs to pitch to? There's a lot of different ways, and I can kind of go through that a little bit. Like there's ways to Google your industry and what venture capitalists are there. And then you can also look in a directory called Crunchbase or PitchBook. Both of them have any investment that any VC has ever made is in Crunchbase or PitchBook. And so you can look and see like who are the people who have invested in, Motivo or Hazel that was with us last week, or, any startup you can see. And so then you can look at those VCs and look at them a little bit. I also included some of the best VC for mental health in the pitch deck later on. Also, What If Ventures, Stephen Hayes. If you don't know him, great person to follow. He has What If Ventures, only invests in mental health startups. And he put together a huge list of any VC who's ever made 2 or more investments in mental health. And that's also in my pitch deck later on. So, thank you for that, Jacqueline. Okay, let's see. Is there a negotiation aspect to the accelerator? Is just the fee for participating? There's not a negotiation aspect to it. Like if you get in, you take their terms, and usually their terms is 6% for 125 to 150,000. And it's kind of low stakes in the sense that like if the company doesn't go anywhere, it doesn't matter that you sold 6% of it, and if it does go somewhere, it's going to go somewhere partly because of what you learned there. Like you also have a lead investor. I'll get into this later on in the pitch, but you have a lead investor who's like the main VC who sets the terms for your investment round. And ours is Cox Enterprises. And we met Cox Enterprises at Techstars. So we wouldn't even have gotten an introduction to almost any of the investors, angel investors, or VCs that we've met without going through Techstars. It was the open door to all the advice and all of the VCs that I've ever worked with, really. And can you please recommend some good podcasts or books? Yes, I have a whole slide on it. So let me dive back into the pitch. Some of your questions might even be answered as I continue on, and then I'll pause again for more breaks. So here's some key terminology. I don't expect you obviously to have to remember all of this, but I just thought I'd give an overview of it. And if it's helpful, great. So fundraising, that whole aspect is just basically obtaining capital money from other people in exchange for equity, which is ownership in your company. That's what it is. Equity is, individual shares in your company. Each of them represent a dollar amount. So you might have 500,000 shares in your company, each one for a dollar amount. And those shares are what you're selling when you take money from other investors and give up ownership in your company. The convertible note, a convertible note is a very early investment vehicle. It's basically that $125,000 that I got from Techstars that came in through a convertible note. Almost all accelerators give you the money in a convertible note, which means that you're too early to know how valuable the company is. And so they are basically saying, here's some money. This money is going to convert into equity when you have a priced round later on. And then that's when we'll get our equity, and we'll actually get a little bit of a discount on it because we invested early. So I hope these two things make sense. The way that money comes into investments are convertible notes, which means you're too early to know what the valuation is. And so it's kind of like a IOU early on, or a priced round, which is there's a valuation of your company that's set. They're saying you are worth $5 million. And so this amount of equity is worth this amount of your company. It's based on the valuation they give you. That's the priced round. And all the investors agree to that valuation. The company agrees to that valuation. And it's what sets how much you're selling off of equity. And the valuation ideally goes up with every round. You want it to go up and up and up. So you're selling less of the company as you're taking in more money. I hope that wasn't too confusing. It literally took me like 4 years to understand this. So if it's confusing to you, don't worry. It is confusing. So the lead investor, again, is just the main investor on a price round who is setting the terms. They're saying, we want to invest in Motivo. This is the valuation that we're giving them. So this is the amount of money that we're giving you, and this is the amount of equity we're getting for it based on that valuation number. And the valuation is a bit ambiguous. It's not really truly how much your company's worth. It's basically just how much they're saying the lead investor says that it's worth, based on how big your market is, based on the market conditions right now, because money has started to change. Fundraising has changed a lot because of, the pending recession. So terms are worse for founders where they were better a couple of years ago. All those things play into the valuation they give you. And the term sheet is where they put all that information. So it's the sheet where they say, we're the lead investor. This is how much money we're going to give you. This is the valuation. This is who gets a board seat. This is who gets a right to vote. And this is who gets preferred shares. Preferred shares means that the investor gets paid back before the founder does, basically. Few more terms. I know this is kind of like the maybe boring part of it, and I'll get to like the more exciting part. But the other key terms are total addressable market. So basically it's just if every person who needed your service bought it, how big would that be? How many people need clinical supervision in the US, basically, for us? Product market fit. You can't just say your company's product market fit because you have a couple of customers. It's like you have enough customers to sustain growth and profitability. So you have enough customers to someday get profitable, which means that you're, bringing in more than you're spending to pay for the service. That's product market fit. And then customer acquisition costs, lifetime value, these cash flow, like burn rate, these are all things investors ask you about in a pitch. How much does it cost to acquire every customer? So you'd put in all your marketing spend and divide it by the number of customers you have. Lifetime value is like, how much can you make off this one customer for their lifetime? So basically for us, it is like, how much money does someone spend on clinical supervision for the 2 years that they need clinical supervision? Cash flow positive and profitability are the same thing, means that you're bringing in more money than you're spending. Burn rate is the amount of money you spend each month. And then bootstrapped is the complete opposite of everything we're talking about. But I thought I'd mention it. It's a founder who doesn't take any outside capital. It usually means they're working for free and they're just building the company and waiting until they have revenue to hire anybody. And it's incredibly hard to do, especially for a tech company, because engineers are very expensive. So it's hard to do. So any questions about any of that terminology? If I don't know, people maybe have fallen asleep at that point of it. I was like, oh my God, I'm gonna have to get through these terms. And I hope that's helpful. And again, we'll give you the deck so that you can dig in and read it a little more thoughtfully. Okay.
I don't know if you're going to get into this, Rachel, but if you want to go back to that, this is a very great overview. I don't know if you're going to get to who actually does the valuation of your company, how that happens on the outside, and that's someone else. Are you going to get to that point?
No, I don't really make that point. So that's a good point. I'll pause there. So yeah, after you have an investment round, investors require you to have something called a 409A, which is an actual valuation of your company. I don't really know. I mean, we've had it and I don't really know what I do with it. Like right now, it's just like in my file. Like that, maybe, you know, if I were to sell the company someday, they'd be wanting to look at that. But you know, but there is an actual valuation that happens of your company. And then there's the valuation that investors give you. Two very different things. Usually your actual value is much lower than what investors give you money based on. I'm glad this is helpful. Okay, good. Did you find the VCs you pitched to be fairly astute about mental health and the challenges? You know, a good question, Michelle. I think some, for sure. There are a lot of the people, like VCs all mostly pick a lane, you know, like to kind of describe it of like, you know, in therapy terms, they are like CBT or DBT, or, you know, they're picking like a model or an industry that they're focusing on. So there are healthcare investors, there are, you know, SaaS investors, you know, software as a service, that they're all they're doing are like HubSpot or Salesforce or technical Slack, you know, technical tools that are used, and that's all they invest in. So I would say that there are some very astute mental health VCs, and they're fantastic. And I'll go over which ones they are. They care about the industry. You know, VC gets a bad name oftentimes because there's a lot of bad things happening in the VC world, but it's not, you can't throw the baby out with the bathwater. There are a lot of VCs out there that really want to make the world a better place and are utilizing capital in order to do so. We wouldn't be here without VCs. There's no way I could have bootstrapped this on my own. Motivo would not exist without investors. Was there a time you felt like you did not need investment because you have 1 million ARR? No, I mean, there will be. Like, Motivo's goal is to be profitable. As I, you know, I think every startup should hope to get profitable someday. So yes, there will be a time that we don't need investment, but there hasn't been yet. So I don't know which way you're asking that question. There hasn't been yet. Our burn rate is higher than the money we're bringing in. It's very typical for a company of our stage and size. Again, it's because engineering costs so much money. Developers cost a lot of money. Everything, like also the amount of mistakes that you make, at least for me as a first-time founder, I made so many mistakes. If I had to do Motivo over again, I would get to this point in like half the time, because you don't know what you're doing. And everything is like a test and everything is like well, let's just throw this and see if it sticks, you know, so marketing, sales, the hiring that you do, how to lead a team, like all of that, it's just like super, super hard, you know? And so I feel like a lot of the investment that I have gotten so far has just been like learning. And now I feel like I understand more about how to scale the company, but it took a lot to just get to this point. What are the challenges you face working with investors and VCs? You know, early on, I would say it was like being able to show the big vision of Motivo, like, and I talk about this a little later on, Zeal, like you have to have like a really big market size. And even if you're solving a really important problem, that's like totally an important problem, but you don't have that big of a market size, investors are not going to be interested, because you have to demonstrate that you can become like a unicorn. A unicorn is what's called a company that has a valuation of $1 billion. Like, this is like crazy kinds of money we're talking about. So I had a hard time showing that story with clinical supervision, like how, you know, of course, nobody ever said this isn't a real problem that you're solving. And that is the other issue that people can have with VCs, is that you're solving something that's kind of a problem, but not really a problem. Clinical supervision is clearly a problem. Nobody says that that's not the case, but they definitely told me that it's not a big enough market. They said it was a lifestyle business, and a lifestyle business is hurts my feelings. It's like, that's a big enough.
They said that this was a lifestyle business?
Oh yeah, for sure. Which is like, that's enough to
Wow.
make you
The
wealthy, but not
disrespect.
a big enough company, Yeah. Oh, and I also had people ask me, investors, if my husband gave me the idea, which was like weird. But that's not typical. That's very rare that you would hear someone ask something like that. Those are a few of the challenges. I might think of more. So let me dive back into the pitch, and then there's some more insights to share. Did your husband give you the idea? I still am mad about that. So these are a few questions to ask yourself if you're thinking about raising capital. And this is kind of what I just mentioned, is the total addressable market in the billions of dollars. So Motivo's market size is $6 billion. That's how much money is spent on clinical supervision and continuing education in the US. Those are the two things we sell: clinical supervision and continuing education. And you really have to be reasonable with it. So you have, I had to build it from the bottom up. How many therapists are graduating each year, and what's the typical cost of supervision, and how many of those hours do you need each year, versus this is the billions and billions of, if I just Googled market size for mental health care, it would be hundreds and hundreds of billions of dollars, because that's all the money being spent on any mental health treatment. That's not our market size. Our market size is how many of the people of what you're selling, need this. And that needs to be really big. Even 6 billion is not that big. And then, is your company a nice to have or a have to have? So that's really determining, is this something that people really want, or is it just something that maybe they might want? And there's a great book called The Mom Test that basically, it's your mom's going to tell you everything's great. So how can you ask questions to your customers that are really get real clear feedback on whether or not they would want your company if they didn't love you like your mom does or whatever. And then there's also a great product market fit survey that the founder of Superhuman, I'm blanking on his name, came up with. It's basically the question, how disappointed would you be if you could never use this product again? Something like that. And it's a really great question for determining, if people would be disappointed if you went away tomorrow. And then, can you raise enough money to beat the market leader? So, Motivo is we benefited off the fact that we were the first ones to do virtual clinical supervision, so we didn't have competitors. But if you're trying to get into the virtual care space, for employers, there's a lot of people doing that. Or if you're trying to do the, matching process between a therapist and a client, I've seen many iterations of that particular startup. Great idea. But do you have the ability to raise enough capital to outspend or to outperform the other people who are also doing that? Psychology Today, they're kind of like the behemoth. It's hard to take them down. They have a huge market share of people using their product already. It's very hard to steal customers from another place and bring them to your platform. So you got to think about those kinds of things. Few other questions I think are important. Am I okay with the pressure to grow quickly and work really, really hard? So that's a hard one, I think, bootstrapping is ideal from a founder perspective, because it's I just make my own decisions. If I don't hit my numbers, who cares? I'm just kind of growing as I go, and you can just maintain your own, and it's also 100% owned by you. So, famously, MailChimp is one of the only companies that ever, bootstrapped and, went into $1 billion valuation. But part of the reason they did is because their founders were product people, if I was an engineer, sure, maybe I could have built Motivo. I don't know that I could have sold it, but I could have built it, but if, most therapists aren't also engineers. So having those engineers build the product is really what takes, some capital. And then, do I have a strong enough sense of self? I think this goes really well with the next one. And this is just a personal ethos for me. Do you have a strong enough sense of self to stay true to your moral compass and your mission? The people who have invested in Motivo, the funds that have invested in Motivo, they let me lead. They believe that my domain expertise is important to the growth and health of Motivo. They never push back in these really aggressive ways. They're never like grow, 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 grow. Like there's a lot of investors that are, what's called impact investors. It means that they care as much about the impact that you're having on the world as they do the financial return. And so, of course, my investors want us to be very successful, and they want us to return the money and then some that we have, taken from them. But like they also just care about what we're doing in the world. And there's a lot of investors that are out there. And if there wasn't, and I only had investors that, maybe weren't that way, would that be enough for me to walk away from it? I mean, I think it would for me, but, knowing at what point you'd want to walk away from an investor is important. And then this is one that's kind of not in your control, and it's totally timing. And I truly believe one of the most important indicators of startup success is timing. I don't know that Motivo would be as successful as we are right now without the tailwinds that came from COVID, and of course, like that's a terrible thing that happened in our world that impacted so many people. And in healthcare, it accelerated a lot of advancements that should have already happened around access to care. And a lot of these supervision rules, I always think about the one in Kentucky. Kentucky had a rule around virtual supervision saying that you couldn't breathe the same air. You had to breathe the same air as your supervisor once a month. So 3 of your sessions a month could be virtual, but once a month you had to breathe the same air. And so obviously, nobody wants to breathe the same air during COVID. So that rule went away. But like, those are some of the examples of advancements that helped Motivo that I could have never foreseen, and so you could be 2 years early, you could be 2 years late, and some of those things you just can't control. So I'm going to go into some of the lessons learned, but let me just stop share right here and just see if there's any other questions. Oh, good. I'm so glad you're putting those in there. Jacqueline. Okay. So if there's no questions right now, I'm going to go back to the lessons learned. Okay, great. Okay. So this is something that Paul Graham, who was the, founder, I also don't know if he's the founder or the first, just like executive director or whatever, of Y Combinator, which Y Combinator is definitely the premier accelerator. If you go through Y Combinator, very hard to get in, they rejected us. But if you go through Y Combinator, you're guaranteed to raise money because there's people just waiting to give money to the last company that come through Y Combinator. It's in San Francisco. But he did this startup curve that I think is absolutely true. And it has to do with like the initial enthusiasm that comes when you decide to start a company. So we went through Techstars. We're like so excited. We had like 4 employees. We do this big demo day on this huge stage with like hundreds of people and all these investors. And then afterwards, like nothing happens. And this trough of sorrow is so real. It's all this initial enthusiasm. Maybe you're 30 under 30 on Forbes, like all this kind of interest, like this is so cool. Look at this brand new idea. But then the actual like aspect of like growing a company is super hard. You make mistakes on who you hire. Your pricing strategy isn't right. Your marketing strategy isn't right. There's something wrong with the product. All of those things are some of the problems that early startups experience just to start getting traction. And so hopefully this is what happens, is that you get to the point to where you've had these successes and failures. I remember when our revenue was like going like this and we didn't know why. We'd be like a great month and a not great month. And, you can't raise money with a great month and then a not great month. You can only raise money if you're going up, so all of those things made it super hard. And I just think this is a very fitting visual of exactly what I have found the founder journey to be like. So a few things that I've learned, I think there's 3 slides here of things that I've learned from pitching to investors. Investors have a short attention span, so being as concise as possible is really good. Just say it in as few words as possible. Your entire pitch to an investor should be less than 10 minutes. Most investors pass. I've gotten rejected so many times, and I definitely like the fast no over like a slow maybe. A slow maybe is like the worst. And then there are reasons that investors pass that are just completely not within your control. Sometimes they've just raised their fund and they're not ready to put in their first investment. Sometimes they've already invested in a couple of mental health startups and they're not going to invest in yours because it could become, a competition, a million different things. A competing deal flow. They just have too many companies that they're interested in all at once and they can't focus on just yours at that time. It's your responsibility to know what stage you're at. Usually that's based on revenue and what funds invest in your stage. They put that on the website. They'll say we're seed stage, we're pre-seed, we're Series A. They'll put that. And then self-care and founder sustainability is everything. So there's like 3 things I do for my self-care. I run every single night. I take Celexa because it works. And I have a therapist. And those 3 things like help me with the founder journey. It's best not to reach out cold to an investor. So the best way, and I learned this in Techstars, best way to reach out to an investor is to ask for an introduction through someone who knows that investor. So you'd look at the investors, as I was talking about earlier, go to Crunchbase, who invested? Oh, okay, someone here from like Bessemer, which is one of the best healthcare investors. Am I connected with anybody who's a partner at Bessemer or an associate? Associate's like low level of the investment fund, and it's principal, and then it's partner. So am I connected with anybody who's at any of these VC funds? And if you do have a connection there, you can ask them. You can write up basically what's called a forwardable email intro. That's like, here's who I am. Here's the company I'm working on. Would you be willing to introduce me to your contact, such and such? Best way to do it. And then your pitch gets better as you progress. So pitching midway to the funds you like the most is a good idea. And then I put in just some kind of tactical things around your slides with page numbers and then, kind of how you can list the problem. And I put an example of my deck here, so you'll see this. So last thing on a few things I've learned, you need to have strong answers for why now and why us. So early on, the investors are only investing based on you as the founder and the team, that they don't have any other data points to go on. So it's just like, do I like this person? Do I feel like they can do it? Are they showing grit? Are they showing domain expertise? Can they do this? And they're just guessing and hoping. And so being able to say, this is why we're going to do it. And then later your investors they just want to see growth and traction, and that's why they invest. Someone told me this very early on, new level, new devil, and I love it. It never gets easier. Every stage just presents its own unique challenges, and it truly is best to just enjoy the journey. Like I just try to enjoy life as it is right now, building my company rather than thinking about, what I can't control later on. And then reviewing the fund portfolio. The portfolio is on the website of every VC fund as well. It's just all the companies they've ever invested in. So you can, say, I see that you invested in such and such. That's great. Similar to this or whatever. And then you might get a lot of emails once you start being a founder from just like growth equity, basically saying like, oh, it's kind of like cold emails that you get from investors. And if they say growth equity, or if they say, what's the other one? Growth equity. I can't remember the other term I'm thinking of. But if they say those things, then just push back a little bit, because usually growth equity doesn't start until you're at 5 million in revenue. So you might not want to take the time. And then associates are great people to get on your side at the VC fund. They're more accessible than partners, and they can be some really big cheerleaders. And then lastly, this is probably my most important advice, is that focus is everything. Like being able to focus on doing one thing really, really well is so much better than trying to do everything. It's all about just doing clinical supervision better than anybody else does it. We just do clinical supervision. That's what we do. So doing that is super important. And then I just put in a few questions here for investors. I won't go through those. And then let me stop sharing my screen, and then I'll go into what investors look for. How long of a runway did your 2.2 seed round give you? So you should try to have about 18 to 24 months of runway with each round. That's kind of the goal. It did give us, let's see, we raised in 2019, 2021. 22. It gave us about 3 years of runway. So you can manage that by your burn, how much are you spending each month to see how you can like lengthen it out. That's what we're doing right now with our Series A. We're like, because it doesn't look like it's going to be very easy to raise in the next couple of years because of the recession. So we're looking at like, how can we like make this last as long as we can and still grow. So yeah. And how soon after your seed round closing did you start fundraising for your Series A? I would say it took me a full year to raise the Series A. And it was so hard. It's so hard. But I would say maybe like 2 years. And then I started raising the Series A. And when did I start taking a salary for myself? I did the second year, I think. Yeah. So yeah, I think I paid myself nothing the first year, 30,000 the second year, and 60,000 the next year. So I just kind of moved it up, gave myself a little raise as we raise more money. I don't know what the right answer there is, but that's how I did it. And okay, what do investors look for? They look for, like I've mentioned, a very large market size. They know that out of 10 investments, 7 or 8 companies will fail. 90% of startups fail. Most startups fail, and then 1 to 2 will break even, and maybe 1 will become a unicorn. But they become so big, that they pay back the whole entire fund that they raised. So the unicorn status is, and Motivo doesn't, that's like, I don't know that Motivo will become $1 billion valuation, just honestly, but like, we want to have a significant impact on the world, but, $1 billion valuations, you think of like the really, really, really big companies. So they want to make sure every single company has the potential for unicorn status. Strong team. So you either have to demonstrate past success, you've done it before, or deep domain expertise, ideally both. So first-time founders have a pretty steep learning curve. So it's good to bring people that have done it before. And then big vision. So, what are you going to do to make the world better in some kind of really big way? And it's really good if you can show how you're doing one thing really well, but how there's potential for other growth in different areas. And then integrity, like putting your numbers right. I think this is something that I think female founders do really well, sometimes too good. Like if you've ever heard like that statistic about like that women sometimes will only apply to a job if they meet 100% of the requirements, where men will apply. This is very stereotypical, just I'm making a broad brush here, but men will apply if they meet like 70% and be like, I can do the rest. I found that female founders do that sometimes too. I certainly did, where I'm like, I want to be right about my numbers. I don't want to say anything that's incorrect. Whereas there is a whole lot of just like, demonstrating how big the company can be if everything went just your way. And I had to start doing that a little bit more, of just showing the big vision of what we could do if everything went really, really well. Founders who are coachable, therapists are better at this than anybody. So, and we're also really good at leading healthy teams. So this is why I think there should be more there, because think about how much businesses talk about emotional intelligence. That's something that most therapists already have and have learned. And somebody who can keep their ego in check, I think, is what, a lot of investors like to look for. And then strong unit economics, meaning the price that you'll be able to get to profitability eventually. And that's becoming even more important now. And I cussed a little bit here, so shit investors say and what it means. So 3 things like this, a lot of times they'll say, we'd like to stay in touch. We'll consider you down the road. They're just being nice. Usually that's just a nice way of saying no. I found it to be not nice, because I'd rather them just say, no, this isn't a good fit for us, because sometimes it gave me like false hope until I learned what that actually means. We like to get to know the founder early on. All VCs say this, even the ones I really, really like say, we like to get to know the founder early on. And what I find problematic about that is that if I were to spend time pitching to every single investor, I wouldn't have time to run the company. So you really kind of have to be careful about how many investor calls you want to be on, especially once you start getting traction, because, you couldn't be on the calls all the time. You'd have no time to run the company, except for when you're actively fundraising. And then this sounds niche or a lifestyle business. They're saying they're not sure that you can grow it to venture scale. And then lastly, I'll just give a few fundraising statistics. So 90% of startups fail within the first 5 years. Usually the reasons are running out of cash, product market fit, like there wasn't a co-founder, distraction, or lack of understanding of your market. 1 in 3 startups that raise a seed go on to Series A. I've already said the more credible startups die between seed and Series A. And it's harder to get funding as a woman. So only 2% of venture capital goes to women. Only 0.34% goes to women of color. Really big problem, but some really important funds that are only investing in women. A lot of Motivo's investors only invest in women. And then some great funds that only invest in people of color, which is, they're making a difference, but it needs to be better. And then the part of the reason for this is that there's not women in many of these VC funds that are making these decisions. And then I just think that this is always interesting when you think about like selling, stock in your company. The average percentage that founders own at the point of acquisition. I mean, this is like big, but you've been super successful. Someone is buying your company for millions and millions of dollars. It's usually like around 11%, which I thought was kind of interesting. And then I put this list here from What If Ventures. It's so good. I can't even tell you. I'm just going to click on it real quick. Steven went through of the 100 mental health he tells a lot, but look at this. Like these are all the funds that have invested in mental health startups, which is it's a really invaluable resource. And then here are a few of my faves. So 406, gosh, I have so much respect for them. They're fantastic. All of these funds right here invest in mental health, sorry, blanking. And a few of these invest in only women. Still Sky, Mindshift only invests in women. So those are some great things. Okay, I think I'm almost done. This is the sample pitch deck, and I'm not going to go over it. I'm just sharing it for your reference. I put a few things here at the beginning of like what to put in the main slide and what to put in the appendix. And then this is our pitch deck. So I'll give this to you if you want it. And then lastly, here are some resources, a lot of books that I read that I absolutely loved that were pivotal for me. And then podcasts I listen to even still on the regular that are super helpful. So that was a lot of information. I hope it wasn't too boring, and I would love to answer any questions. So Julie, you already did that one. Do you have a co-founder? Yes, I do, but I didn't until my 3rd year. So I was just me. And then I thought about writing this like little children's book. You know how there's like that children's book that's like, are you my mother? Are you my mother? And I was going to write one that's like, are you my co-founder? Because I literally almost made like 5 people my co-founder before I knew better. I was like, oh, you could build a WordPress site. Can you be my co-founder? And I'm so glad that none of them accepted because they weren't the right people. This is part of the problem, is that like when you're getting started, unless you just know an engineer that's like really, really, really good, it's hard to find the right team. That there's another like quote that says sometimes your startup team isn't your scale up team. Nobody who was in the early days of Motivo are like with us still. So, I mean, that's it's just the way it is. So yeah, my co-founder is Mike Chen. He was from Airbnb and Google. He's fantastic. I got him because I saw at the beginning of COVID, one investment firm put out a list of under-recognized talent, tech talent that had been laid off because of COVID. And Airbnb had a lot of people on that list. And I found someone who became our COO, Sarah. She was good friends with Mike. And so she brought him on. And it's such a great question, Michelle. What's the most fun part about this journey? I mean, it's just really cool to like put something new into the world. Like, I think because like one of the things that I like that Paul Graham says is that he said, like there was like Stanford students asking him like, how can I think of like the next big idea? Like, how could I become a millionaire or whatever? And he was like, go and learn a trade, learn a field, and then find out what problems exist there. And so like, I don't think I could come up with an idea about just anything, but I could come up with an idea about something that I experience or that I care about. And so I think it's just like really cool to like, come up with an idea. Jacqueline, let me ask you, do you want to ask? Now I'm just like reading them, going through. Is that okay?
Yeah. This is perfect. Yeah.
Okay, good. All right. I'm just realizing I'm just like talking too much, maybe. How did you search and hire an engineering team? I hired wrong almost exclusively. It's just hard. It's very hard. So now
how did you improve on your hiring?
By failing and then learning. So I think every time I got it wrong, I was like, oh, okay, like this is, I think a lot of it was, to be honest with you, I over-indexed in the beginning on people who cared about the problem that we're solving, and everybody cares about mental health. And that's one of the challenges for me, is that like, I just hired people who were enthusiastic, who were like incredible humans, but maybe they had never scaled a startup before. And those are two different kinds of people, And so being able to find someone who has scaled a startup before is really important. Yeah. Do you have thoughts on advisors asking for equity at pre-seed? I wouldn't do it. We had that and I just wouldn't, I would just say, for now, I just want to pay you and then we'll see, because you could give up a significant portion, like that equity is like precious to you. And you really should wait until you know who you're giving it to. So I would do something like, let's do a contract engagement for 3 months or for 6 months and then see, or have it end to it. Say, okay, I'll give you this amount of equity, but it ends after this year or 2 years, or it's like a small, like a small amount, and never more than 1%. Never more than 1%. That's a lot. Because you're going to outgrow the advisor eventually, like you're going to need a different level. And I will share the slides. Yes. Do you have a mentor? Yes, I have so many. Yeah. So one that I got through the Techstars Accelerator program, they connected me with this guy named Mark Goldenson, who started Breakthrough Behavioral Health that sold to MD Live in 2007, a long time ago. And he was great. And he has been a mentor for a long time. And then, many others. I mean, I got some in Techstars and now I have a board. So I usually go to my board for mentorship. And only one of our board members, we have a 5-person board, only one of them is an investor. The other ones, just giving me industry insight. One of them is a psychiatrist and one's LCSW. So great feedback there. And yes,
how did you find the advisors and board members?
Really a lot of it all builds on itself, like I wouldn't be here without like those very first accelerator programs that I just like took a shot at to see if I could get in and do it. And I actually didn't even end up applying. Here's a good lesson learned. I didn't even apply to Techstars. I thought about applying to it and I had met with them. And then I just didn't feel like I didn't have a team. They kept saying you have to have a team. It was just me. And so I just didn't apply. And then they called me and they were like, we really wanted you to apply. Will you please apply? And like, I think it's just like that thing of like, just thinking you don't really have something, or that you're not like imposter syndrome, you're not good enough, or you don't have enough. And so I just had to start trying even when I didn't know what I was doing. And so all of that built on itself. And, Techstars brought a lot of mentorship and they brought a lot of connections too. That's the main reason to do any kind of big accelerator like that, is that they have so many connections. And I continue to look for mentorship. So good question.
Oh, great questions. Anything else? This was really good.
Was it good? Was it helpful?
Informative. Yeah. Very informative. Really appreciate you being very honest and transparent. I think that's a big problem that we're missing. Like when clinicians want to do big things, they don't have people to just give them plain answers and say what you said, just go and try. Just try, be okay with no, and just try. So I really appreciate that. Yeah, absolutely. It's because like, if
failing is like could happen, but like, what if you win, you know? And I can remember feeling that when I decided to start Motivo, I was like, I have a good idea. I think this is a really good idea. And I didn't know if I should do it. And I just remember thinking like, if I don't do it, I'm going to always wonder what would have happened. And I'm so glad I did, because I can just be like, all right, I gave it a shot and it like worked, you know?
That's amazing.
Yeah. And I'm like so happy to be like a sounding board, you know, anything for people. If you want to reach out to me, I can just put my email here in the chat. You can look through especially because I didn't know if there was like be like a ton of people on this. I'd be like, when I wouldn't offer to make introductions to investors for a lot of people, but there's a few enough people on this that I'm like, if I can be helpful in any way,
Thank you for
I'd
that.
love to be. And also, if you're not a part of like the startup communities, obviously all of you are for therapists in tech, but there's also What If Ventures has a very active mental health startup community where it's all about investing, it's all about product, those kinds of things. So there's, you know, some other good communities happening around this space that would be good to get connected to.
Absolutely. Thank you for sharing that also and all of this information. I really appreciate